Hey everyone, Clint Coons here, and in this video we're going to discuss taxation of your rental real estate limited liability company. All right, let's get started. Now, I get a lot of questions on setting up LLCs. How am I going to be taxed on the income that the LLC is generating? And it really depends, first off, on what level of taxation you elect for that limited liability company. So if you don't recall, LLCs, they're hybrid entities. So you can choose to have your LLC set up as a C Corp for federal tax purposes. It can be set up as an S Corp for federal tax purposes. It can be set up as a partnership for federal tax purposes, or it can be disregarded. All right, now, what is the distinction between these? Well, with the exception of the C Corporation, all of the other three statuses are what we would call flow-through. Well, actually, I'd call it, these two are flow-through right here, and then this one means nothing. I'll explain that. So with an S Corporate partnership, the way it would work, if I have my limited liability company set up, here's my LLC, and my LLC generates $20K in income for the year. So I make $20,000 in income. And I am the owner of this LLC. I'm its sole member, or maybe my wife and I are members together. It doesn't matter. It makes $20,000, and it's inside the LLC. And I don't take the money out. I leave it in the LLC. From a federal tax standpoint, what's going to happen? Well, because the S Corp and the partnership are considered flow-through, your LLC will file a tax return. It has to file a tax return. If it's an S Corp, it's going to file an 1120S. If it's a partnership, it's going to file a 1065 return. So you're going to file tax returns for it, and you're going to receive a K-1 that allocates to you your portion of this income. So if I own this entity with my wife, and we're set up, well, the way she likes it, she's 90%, I'm 10%. So it's set up this way. Then if we have $20,000 inside of there, she's going to receive a K-1 for her share, which is everything, $18,000, and I'm going to get my share for $2K. So that will come down on a K-1 to me. So we get this K-1 that shows she gets one, I receive one, of our taxable income, the income that this company kicked out to us. Now note, I left the money inside of there. I never pulled it out. Do I have to pay tax on that? Absolutely I do. So this is the thing about LLCs many times that people get confused about. When an LLC is set up as an S Corp, it's set up as a partnership, or this disregarded status, which I didn't talk about. And the reason I haven't mentioned it yet, other than just throwing it up on the board, is that when it's disregarded, you don't have to file a tax return. It just automatically hits your tax return as if you owned it in your own name. It's just ignored. You get an EIN, you tell the IRS, hey, I got an LLC, but don't pay any attention to it. It's not there. You do a Jedi mind trick. I don't have an LLC for tax purposes. And so then your CPA would just fill it out, your tax return, as if you own that property in your own name. Now, what does this mean when the money's still inside there, though? Because that's the most challenging aspect for so many investors, understanding how taxes work. So you're going to pay taxes on this $20K. Now, where's that money going to come from? Well, maybe you got money in your savings account or your checking account. That's where it's going to come from. Or you could pull it out of the LLC if you wanted to. If you take it out, that is referred to as a distribution. So the money inside of there, you're taxed on it even though you don't pull it out. So what does that mean, let's say, the following year? So the next year, we've got this structure set up. Let me just get rid of some of this stuff here. I've got this structure set up. It's got $20K inside of the LLC. And here we are in March, and my wife and I decide, hey, let's go on a vacation. Okay, great, let's go on a vacation. We're gonna go to Hawaii, and we're gonna rent a house. And so for this vacation, we need $7,000. But our checking account's a little low right now. Our savings account doesn't have it, but we have this LLC that has $20,000 inside of there. So what do? Do you pay for it with the LLC? I hope the hell not, all right? Because that's commingling, that'll get your veil pierced, and I should probably cut a video on what you should and shouldn't do on that. But what you would do is you would take a distribution to yourself. So you would come up to the LLC and you would pull out $7,000 as a distribution, okay? Now, when you take this $7,000 out of the LLC as a distribution, it's not taxable to you. Why? Because you paid tax on that $20,000 the previous year. So you're not going to get taxed twice on this money. Think of it like a savings account, okay? You have a savings account and you have $50,000 in your savings account, and your bank paid you a whopping $200 in interest this year on your savings account. Do you pay federal income tax on that money? Yes, it's interest income to you. You didn't pull the money out of your savings account. Next year, you take that $200 out of your savings account so you can go out to dinner. Do you pay tax on that $200? No. It's the same way it is with a limited liability company with the money you earn. You're going to pay tax on your earnings. We don't pay attention to how much money you take in and out of the company. Here's another example that comes up an awful lot that confuses people. Let's assume that I have a LLC set up here, and I have a property inside of it, and we have two members down here again in this LLC, and I refi my property. So I go through a loan, I get a refi in the name of the LLC. So the LLC, I refi it, I pull out $80,000 in cash, and I put it in my limited liability company on that refi, do a cash out refi out of that property. And then I turn around and I distribute the $80K to us as a distribution. Is that taxable? Now this comes up a lot. People say, well, you took $80K out of your limited liability company, so yes, that's taxable to you. Again, as long as your LLC is set up with one of these three tax statuses right here, it's not taxable to you. Why? Because this was a cash out refi. That was a loan to your limited liability company. So with the loan, when you're pulling the money out of the LLC, it's no different than if you borrowed the money yourself. Okay, if you borrowed the money yourself, then out of your own house, that's not taxable, okay, because you have to pay it back. So it's not considered to be income. Now, let me put a little caveat there because I know there's going to be one or two, three people that watch this video and say, well, Clint, S corporations and tax basis. I know. So with S corporations, it may be a little different, but I'm not going to go down into the weeds that much. I just want to give you the basics here so you understand that when you take money out of the LLC, it's not, you don't have to worry about taxation. That's not how these entities work. Taxation is based upon the income. In fact, many times when we set up limited liability companies for real estate investors, and let's assume that the LLC, so we're no longer in a loan situation here, let's say it's generating $2,000 a month in income, and they're pulling that income out every month, the 2K is coming out to them. So over the course of 10 months, they pulled out 20K. They start asking, well, do I need to pay and expected, do I have to make any anticipated tax payments on this, quarterly tax payments on this money? And I tell them, well, not really yet, because we don't have any history there to know whether or not this is actually going to be taxable to you. And people are shocked. They go, what do you mean it's not taxable to me? I took $20,000 out of my LLC. I know, but with real estate, it's a little different, because even though you took $20,000 out, until we do your taxes, we don't know how much of that's going to be offset by depreciation. So let's assume that you had $12,000 in depreciation and you had $4,000 in taxes. So that's $16,000. Now we're down to $4,000 of taxable income. But then you had some repairs and management fees of $4,500. So actually you lost $500 when we do your taxes. Do you really want to pay taxes on money that you lost? No, I think not. So when you're taking the money out, don't get too hung up on that. You know, with the LLC, it's a flow-through entity unless it's a C Corp. Now that is a totally different animal, and it doesn't pertain to this, because everything I just told you, if it's set up as a C Corp, you're going to get taxed. So we like then to use residential real estate through flow-through entities. And typically the way we're going to structure them is we're going to go with disregarded or partnership. You know, those are the main two workhorses for residential real estate investors, or commercial or multifamily. That's how I want to go. If it's a flip, we're going to go with the C Corp or maybe an S Corp, preferably always C in my opinion, for those types. So the idea here is just to get a basic understanding of how the LLC works from a tax standpoint, how you can pull money in and out, and don't get hung up on these distributions. Distributions do not equal taxation. Taxation is only based upon the income the business makes, not the money you're pulling out. Because you're going to pay tax on it no matter what at the end of the day. They don't care how much you pulled out or when you pulled it out. If there's taxable income there, you pay tax on it. If you don't, you don't. So use this going forwards. Hopefully it helps you understand how LLCs are taxed. Hey, if you liked the video, give me a like. And if you're not a subscriber yet, make sure you subscribe to my channel. Take care, everyone.